Welcome back. With markets behaving crazily right now, let's just see how a pro fund manager like David Buckland of Montgomery Investment Management is playing the market. David is in our CBD studio. Hi, David.
How are you, Peter?
Well, I guess if I didn't have this flu, I'd say excellent, but I'm soldiering on because of great people like you, David. So tell us, how are you playing this market right now?
I think we need some context, Peter. The market over the last 2.25 years has moved between about 49.50 and about 59.50. So it's had about a 1,000 point range in 2.25 years, and it's at the lower end of that range at present. And for my money, it's just best to completely focus on high-quality businesses with good prospects and buy them well. Now, that said, over the last 3 years, Australians have returned. The Australian market has returned about 9% a year average for the last 3 years. Foreign markets have done about 15% per annum better than that for the last 3 years because of the depreciation of the Australian dollar. And my belief is Australians have been chronically underinvested internationally. So Australians have got to start thinking outside the square, particularly as the Australian market gets thinner and thinner and thinner, and more importantly, as the resource sector, which accounts for 15%, and the banking sector, which accounts for 35%, ends up with a sort of fairly significant headwind. They've really got to think a bit outside just buying the big four and Telstra, as has been put to you on many occasions in the past. But
David, wouldn't it have been better for you to tell me this 3 years ago when the Aussie dollar was $1.05?
Or $1.10.
Yeah, $1.10. I didn't want to really put you on the spot, but that was the best time to buy foreign assets, and those stock markets have done well since then. I guess the next question is, are we getting in at the tail end? Possibly Aus dollar goes from 72 down to 65, and the US market and the European markets still go up, but not as much as we've seen over the past 3 years?
Absolutely. I mean, clearly when you go from 110 cents to 70 cents, the easy fruit is picked. And look, there could be quite easily another 10 cents in it. However, you'd have to say that 80% of the game has now been played. There's maybe another 20% to go. So, as I said, the easy fruit's been picked. But all I'm simply saying is Australians are sort of obsessed about the big four or the big six or what have you. And particularly from a currency point of view or a foreign market point of view, or an even alternative asset point of view, such as a long-short hedge fund point of view, they've got to start to think outside the square, particularly now. I think the Australian economy, as your last guest made the point, is not easy.
Yeah, and also, David, franking credits influence a lot of our investors as well, don't they?
That they influence them immensely, but what a lot of Australians forget about is what about the capital? And we saw between April and August, our banking sector, for example, on average, came off about 25 percentage points. And as your last guest said, there's still a lot of capital raisings to come over the foreseeable future. So it's quite obvious to us that the banking sector has now got a fairly serious headwind, which it hasn't had for several years. So that's a third of our market at least.
Okay, now you guys have set up a long-short fund, so you, in a sense, what you're talking about, you're doing yourself. Why did you do that?
Well, we feel that what happens is that globally interest rates are at record lows. They haven't been this low really since the Great Depression in the 1930s. Secondly, US corporate profit margins are at record highs, and that data goes back several decades and tends to mean revert. So our view is that markets just aren't that cheap. But as I said, they've been trading in about a 1,000 point range now for 2.25 years. And so what we worked out, and we're probably a little late to the party, is that you can actually make as much money on the downside and possibly more than you can on the upside. And in our most recently released product called Montica, which is a global long-short fund, it put on well over 13% after expenses in the September quarter at a time where share markets retreated quite significantly.
Yeah, and of course, the best time to be in a sense, you're becoming like a hedge fund, and so the best time to be in a hedge fund is when you've got volatile stock markets.
Correct. You know, it was an aligning of the stars in that what happened was we saw a currency come back from 77 to 70 US cents, so that helped immensely. But what happened was a lot of our shorts fell very aggressively, you know, 20, 25, 30, 35% for many of our shorts. And so what happens is you can actually come out with a quarter that's where most people have really been bashed up and actually come up with a fairly strong positive number.
Okay, now what about the markets overseas that you want to play in more than not?
Well, I think it just comes down to stock picking, and what I would always argue is that in every market there are very good quality stocks with good prospects that are reasonably priced. And just in the last 12 months, you know, we've seen things like Icentia and International Patent Holdings and Blackmores and Bellamy's, you know, all go up by a factor gains in a market that probably year on year, inclusive of dividends, has basically made us nothing.
Yeah, well, a company like Freelancers, they went up 12%.
Yeah, but what we're trying to do is we're trying to buy businesses that are enduring for the very, very long haul. And I think the thing is, you know, as Australians, our market is definitely getting a little on the thin side. It sort of reminds me of New Zealand, you know, 15 or 20 years ago to some degree, where there's a lot of takeovers and the offerings are getting a little thinner. And so I'm just saying Australians, I believe, are sort of chronically underinvested internationally. And as you quite rightly point out, Peter, you know, I should have been saying this when the Australian dollar was 105 or 110, but the fact remains that you do need some currency diversification, and more importantly, you can pick up some superb medical type businesses or intellectual property type businesses or information technology type businesses that you can't necessarily find domestically.
Yeah, well, give us a name of a classic international company that you either like or dislike, one that you're buying or shorting.
Well, I would say Alibaba and something like Apple would be two very, very good examples of stocks that you can buy in America. One happens to be Chinese focused for the consumer. It's a PayPal, Amazon type equivalent, and everyone knows Apple, of course. But I would say that'd be two very, very good sort of enormous examples globally that you can't get domestically. And on the shorting side, I mean, what's happening is change is happening quickly because of technology and particularly because of the internet. And I think the thing is you try and find change ahead of the pack. So in Australia, we saw the rivers of gold with Fairfax being taken over by Seek.com and Realestate.com and Carsales.com and Webjet.com. Yeah. And we saw a stock, you know, decline 90% as people got it. And the trick is to find those changes and make sure you're early to the party.
Yeah, and I guess a classic example came from today was Walmart, such a brilliant company that's really struggling with a whole lot of, you know, new world challenges.
Yeah, what happens is that very, very successful companies, often their business model matures. And Walmart's a business with revenue of well over $1 billion a day. And what happens is they mature and technology changes things, and suddenly, you know, our children's generation are shopping a lot more online rather than face-to-face. So it changes business models quite radically. Okay, David, thanks for joining us. My pleasure, Peter. Thank you for your time. That's David Buckland from